being squeezed. We are being very badly squeezed. And the thought that, I mean, today as we speak, Kai, the volatility, we saw silver overnight go to, sort of 83, 84, something like that. And then it shot down. I'm looking at my screen here to 74, and it's currently 75. Volatility. Yeah, of course. But has any silver been shaken out? Very, very little. Very little. So this is going to march on. Unless, of course, there is a change in the demand from industrial users. So, the volatility that we see in these commodities is completely different from the sort of volatility that you experience in stocks. And it's a big, big mistake to confuse the two.
According to Alasdair Macleod, silver is rising because real supply is tight, not because of speculation. Factories are demanding physical metal, COMEX stocks are draining, and China is limiting exports. Paper markets are under stress. Gold is acting as a warning that a major financial and currency reset is approaching. Thanks for watching. Give a thumbs up and subscribe to Fine Metals for the latest insights.
Bond yields start rising as markets recognize its risk, then that will pop the bubble. What I would say is that gold, the rise in the price of gold in recent months, indicates that there is a greater risk of this happening now than there was previously. So gold is leading the way on this. Gold is telling us, this bubble is about to pop. And so what we're likely to get, I think, is the recognition spreading from gold into bonds. So we're going to see higher bond values, I think, in the first quarter. Higher bond yields in the first quarter of 2026. Now, that I think will create a market crisis. It means that the Fed will have to come in and support everything, which basically means accelerated QE. I would not rule out the Fed actually buying ETFs, equity ETFs, to try and support the market, because there is this thing in America. The most important thing about financial markets is the confidence it gives to the underlying economy. If the market's going down, it undermines confidence in the economy. So, they believe this. Now, I'm not saying whether it's right or wrong, but what it does tell me is that the Fed is going to be in there buying treasuries, buying agency debt and all the rest of it, big time. I mean, we ain't seen anything like it in QE yet. I think that's going to be the big message. Now, what that does basically is it injects huge amount. And I think to sort of round off this bit, really what we are seeing is the demise of the derivative system, if you like, which in the past has been expanded to satisfy demand, basically financial demand for commodities, and therefore kept a lid on prices. That is coming to an end, and the consequences of that, I think, will be far higher prices, not just for precious metals, base metals, but commodities as a whole. And what does that tell you? It tells you that the purchasing power of the fiat currencies are going down.
I think those are two topics. Let's keep them separate for a minute, because I want to come to the monetary side here in a minute as well, Alasdair. But allow me one very simple follow-up. Why now?
Well, the thing has been, the timing is politics, I suppose, and in this case, geopolitics. I would say that President Trump has actually created this problem for America. With his big, beautiful tariffs, or whatever you call them. And not only that, but he's a spendthrift. So the idea that any sort of budgetary control would come in, dismiss that completely. Now look at it from the outside. You're the Chinese government. You look at this. And, he's monkeying around. He was being threatening 140% tariffs and okay. He climbed down from that pretty quickly. Why? Because China, decided to restrict exports of rare earths, of which America basically has virtually none. And America needs it for her electronics industries. She needs it for defense purposes and all the rest of it. I mean, and there was a reality check. Now, not only that, but on the monetary side, and you can't separate out the two, I'm afraid, on the monetary side, they see what he's doing to destroy the purchasing power of the dollar. The market situation in gold and the situation in silver is that gold is actually quite a different market. Obviously, it's a monetary metal. The thing I would say about silver is it's not being priced as a monetary metal. It's actually being priced as an industrial metal. And, we look at the gold-silver ratio and all the rest of it and get excited when it sort of starts collapsing, which it has been doing, which is very exciting for the bulls. Fine. But the reality in silver is that it's industrial demand which is driving it. And here you have a problem because you have the pricing being in derivative markets, basically, but the demand being for physical. And it's that interplay which is suddenly creating a crisis for those dealing in derivative markets. Because what is happening is that people who need silver for industrial purposes are being forced to go into the derivative markets. And in the case of COMEX, stand for delivery. I mean, this year so far, around about 15,000 tons of silver have been stood for delivery. Now, we don't know precisely who all these stand for deliveries are, but you can be pretty sure there is a very large element, if not almost entirely, due to industrial entities needing this for manufacturing photovoltaic cells, for electric vehicles, for whatever. So silver suddenly is a needed commodity. And the fact that commodities generally are stirring, you also see the squeeze, if you like, on derivative markets in the platinum group metals. That's been very, very noticeable. And also copper, Dr. Copper. And what this actually tells us is that over considerable periods of time, distortions in the fiat currency system have built up. And the distortions are really very, very evident in derivative markets. If you look at the price of particularly copper in gold, prices in gold is real money. Its value does obviously fluctuate, but not very much over long periods of time. Now, if you look at the price of copper measured in gold, then it's about 18% of its long-term value. In other words, it has been suppressed while at the same time it appears to be rising in fiat currency terms. And at one of these conferences back about, 10, 12 years ago, something like that, I spoke to a bunch of silver mining and silver exploration companies, and I asked them, how do you turn your silver doré into wages and to pay the energy bills? And the answer was quite simple. They said that the man from Trafigura or Glencore came round, he valued it, told the bank, which was presumably JP Morgan, and on that basis, the account was credited at JP Morgan, and the doré was then shipped off. Where was it shipped off to? Well, we don't know, but we assume it's China. Well, of course it was China. China not only is today the second largest mining nation by silver output, but it imports doré, not just silver doré, but also other metal dorés from which it extracts silver, bearing in mind that over half of silver from mining operations comes from non-silver mining operations. The result is that China has built up a huge, great stockpile of silver secretly. I mean, it's you can work this out for yourself. It's quite simple. But what China is doing from the beginning of next year, in other words, in a week's time, is it's introducing a new export licensing regime, which is designed to restrict the quantity of silver flowing out of China elsewhere. And this is happening at a time when India its economy is roughly where China was maybe 20, 30 years ago. It is booming. I mean, it is rapidly industrializing, and its demand for silver is off the charts. Where do conglomerates like Reliance Industries go for their silver? Well, the answer is, they go to the refiners, and refiners say, "Back of the queue, mate." They go into London, and they buy it off the bullion banks, who will sell a forward contract, and then they stand for delivery. They go to COMEX, and they buy futures, and they stand for delivery. So markets are being drained of liquidity. And the problem in London is that, you look at the numbers in the silver vaults and you think, there's quite a lot of silver there. Yeah, but it's all ETF silver. And, it's calculated that the non-ETF silver, which some people think is the float, is around about 140 million ounces. But a lot of that is actually in firm hands. It's not available in the market. And this is why the lease rates rise. And I would make a further point. I mean, investors look at commodity prices, and they see these commodity prices rising. And they think it's rather like, let's say, dealing in NVIDIA or Microsoft or, one of these things, or even like dealing in a mining stock. And they think, well, it rises so much, you're going to get sellers. Because obviously, when the price rises, it rises to the point where supply comes in and satisfies the demand. So that's the price level. And when you get there, what do? You take your profits. Yeah? But this is not what goes on in commodity markets. There is not that liquidity. The traffic is one way. It's all producers, not so much producers, but it is the industry which is demanding this stuff. And they're all demanding it at exactly the same time. Meanwhile, mine supply is inflexible. And then to have China turn around and say, well, we've told you the story on rare earths. Now telling you the story on silver, and antimony was another one on this licensing thing. The balance is obviously in derivatives. This is not a balance in physical. It's derivatives. It's an important point to understand. If you get counterparty risk escalating in derivatives, then that itself is likely to drive down total value of derivatives, open interest, if you like, on COMEX, and at the same time, increase demand for physical. So, we're on the cusp of something changing here, even though the system reckons that it doesn't have a problem in gold because it's short COMEX, long London. So what's to worry about? The problem is if you get an increase in demand for the physical, then Houston, there is a problem. But that is ahead of us. We're already seeing this in silver. And silver, which is a more restricted market, quite clearly. I mean, I was looking at the information on swaps, and I think the swaps are short of about $10 billion worth of silver. That's just one category. And of course, the other problem swaps have is that the other categories, the producers and all the rest of it, I mean, they must be looking at this sort of price rising. They know what China's doing. These guys aren't fools. So what do they do? Are they going to hedge their production in the market? No, what's the point? Which throws the emphasis back on the swaps. I mean, the financialization of derivatives, I think, is going to turn out to be a huge, huge mistake. Huge mistake.